Good morning and welcome to our third quarter market commentary video. I'm joined by my colleague, Jason Staley, our Chief Investment Officer, and we want to spend a couple minutes just highlighting some points that Jason alluded to in the most recent letter sent out to clients. Jason, how are we doing this morning?
It's a cold fall day in October. We had a few days of 85-degree weather in the middle of the month, and I think Mother Nature's letting us know that we're not going to get a full extension of summer like I think we were all hoping for. So,
all right. So let's get into kind of the nuts and bolts of the letter. I thought you did a nice job with the letter, and within the letter, you weave in a couple points that I think we wanted to elaborate a little bit further on for the audience. I think the first one that I take away is obviously your phrase. The second quarter letter was revenge of the normal, right? And this one a little bit more building on that. Let's just jump right in, right? Inflation and interest rates. Give the audience a little bit more there.
Yeah, I mean, I think what we're seeing here, and the reason that we tagged on kind of more normal with the side of inflation, was because we started to see the effects of all the fiscal and monetary stimulus coming through the system, pulling 5 years of durable goods orders forward, and what that can do to supply chains. And right before we went to record this, the third quarter GDP came in at a 2% estimate versus 2.8% expected. And I think a large portion of that can be attributed to supply chain issues, bottleneck issues. Try to buy a new car. There's not a lot available. If you can buy something on the lot, I would suggest you probably want to go do that. If you were to go to the West Coast and be in Southern California, you would see it's almost like a floating parking lot of enormous container ships. And it's just because the Long Beach City port can't physically offtake. They don't have the labor, they don't have the truck drivers, they don't have the crane operators. There's just not enough people to physically take the containers off the ships. And I think that takes a toll on economic activity, right? I mean, those goods can't be sold. They can't be, the widgets can't be combined to make, the end widget. And I think that what we're seeing there in terms of, that inflationary print was very indicative of the quarter that we had, which was concerns about it in July. And August was a very good month for equities and risk assets. And then you had September, you kind of had a 4 to 5% kind of sell off at the end of the month because of some of this supply constraints. And I think that that's going to be something that we're going to be struggling with, as this idea of, is this transitory? And by transitory, when the Federal Reserve talks about transitory inflation, they're saying that it's not going to be permanent, that it will move through the system and that we'll eventually get to a more of a steady state. They've sort of moved the goalposts a little bit, have acknowledged, Jerome Powell has acknowledged in speeches recently that inflation has been a little bit higher than they expected, and it's lasted a little bit longer. That's not to say that we're going to be in hyperinflation. That's not what I'm saying, and I don't think that's what any reasonable person should be saying at this point. But I think that this idea of higher than expected inflation and what that means for risk assets is certainly something that's going to affect capital markets into the fourth quarter of 2021 and then into the first and second quarter, the first half of 2022.
To be fair, I mean, inflation's running at, if you were to believe the numbers that are being printed, right, 5.5. I mean, hyperinflation, you're running at 50+%, right? I mean, so we're not even close to.
I mean, hyperinflation is what they see in Zimbabwe or Venezuela,
right.
And
right.
It is almost such a destructive event that it's not really responsible to talk about it, other than to say there are people that are calling for it, and I just don't think that that's representative of the environment that we're currently in.
So, and then the other maybe point to highlight on inflation, let's talk about interest rates, right? So the 10 years at, let's say, 1.5, at the beginning of the year, it was at 0.9, right? So a decent sized move. We've talked about that in the past, right? So give the audience a little bit more. Look, we've been saying rates are going to rise for the last decade, and they really haven't, right? And maybe today's GDP number gives pause for tapering inevitably, I think, starts this month, or I believe it starts in November.
Right.
But real assets and kind of some of those things that structurally we've tried to think ahead and tried to position accordingly for clients.
Yeah, over the last 24 months, I think that what we saw was that could rates go down further? Yes, they could. And the 10-year hit 32 basis points, 0.32% during the height of COVID in March. But looking forward, and one of the things that we've been doing, over the course of the last 18 to 24 months has really been leaning into this idea of real assets. So farmland, timberland, infrastructure, high quality commercial real estate, things that benefit from a rise in inflation, both from the asset values going up and then also being able to pass through that cost, right? You get to sell food, higher prices, right? Building more houses, supplies get constrained, right? So you're able to sell that timber for more money. And then similarly, infrastructure has a tie to energy prices. So there's a nice you kind of get a nice tailwind there. And really, what we're looking for at the end of the day is how do we get a winning edge into client portfolios? And real assets have multiple levers to pull on. These are highly contracted assets. These are mission critical, both for governments and the way that we live our everyday lives as humans. And so there's a lot of really good reasons to lean into this real assets. And
Right.
and the other alternative is just to say we're just going to own bonds, and wherever the interest rates are, we're just going to own them. And I have expounded upon this in letters. We are never going to abandon our wingman, right? I'm a big Top Gun fan. I believe in having core bonds. I will be Maverick. I will be watching, but the overall point of that is to say that we think that you're going to have some core fixed income in your portfolio, but we're not going to be like an ostrich and stick our head in the sand and just not be aware of where rates are. And we need to have something else in our portfolio that we can lean into that's not interest rate sensitive, that has the ability to rise with inflation. And it's really been a differentiator and a winning edge in our client portfolios, which is, this idea of leaning into real assets is something that we've been doing for the last 18 to 24 months. And I think it's been a differentiator for client portfolios.
I mean, in my client meetings, you can clearly see clients are benefiting from this over the last 18, 24 months, that differentiated exposure within, a potentially rising environment. So let's segue now. Let's get into maybe the equity side of things, and specifically, let's go to emerging markets, right? You can see in the chart that we included in the quarterly letter, EM was off 8% in the quarter, right? And obviously the Chinese Communist Party and kind of the noise that was created, in the quarter. So maybe give the audience a little more there.
Yeah, I think that this happens from time to time, every 5 or so years, typically around some central planning meetings that the CCP goes through. They're going to saber rattle, and I think in this regard, there was the Xi Jinping, the premier of China, saw a lot of these tech billionaires, most prominently Jack Ma, who is the founder and former CEO of Alibaba, become not more powerful than the state, but amass more power than I think the CCP was comfortable with. And I think that the Chinese Communist Party is very okay with a lot of people getting wealthy, but they are not okay with, let's just say, exercising what we would consider to be First Amendment rights, which is the right to kind of free speech and to kind of expound upon what you're saying. And that's not to say that the Chinese equity market is uninvestable. What it is to say is that you kind of have to align your portfolio with where the government is going. And the government was going against a lot of these tech platform companies, their versions of Google, Facebook, Microsoft, Amazon. And what happened, not dissimilarly to the market capitalization of the emerging markets, is very similar to the market capitalization of the S&P 500. All of those kind of work from home information technology stocks, they represent the big part of the index. So the index dropped in large part because of these, because of what happened with Tencent, with Alibaba. Looking through the noise, and one of the reasons that we are really a big fans of emerging markets over the long term, it's one of the few places you're going to get growth and above trend growth in the world. And not to mention the fact that they're adding tens of millions of people into the middle class when you look at China, India, Indonesia, the rest of Southeast Asia, Mexico. These are places that are adding to the middle class, and we've seen the middle class struggles here, but we've also seen what happens when you have a thriving middle class that has a lot of disposable income. Look what happened to the United States after World War II, when the greatest generation came home, started formulating housing, having kids. I mean, it led to a manufacturing and industrial boom that really made us into the power that we are today. We similarly think that, emerging markets are going to be a great place to compound capital for clients. And it's one of the reasons that we took it to a strategic overweight, over the summer. We kind of waited until, when we went to that overweight, emerging markets were flat for the year. Now, did that contract a little bit? Sure. But we think looking out, 1, 3, 5, 7 years, we're going to be really happy with the exposure we have to emerging markets.
I mean, in kind of layman's terms, the opportunity set with emerging markets is they continue to find ways to monetize population growth and harness their ability for economic activity. Now, is it going to be volatile? Yes. And that's probably, not probably, that's why we right-size some of your exposure to EM relative to maybe international developed. And maybe let's final point to cover, let's get into the domestic side of things, or U.S. capital markets, right? You touch on growth versus value. And then I wanted to, touch on maybe the month of September, because we did get some client questions, off 4.5%, 5% on the S&P 5 in the month of September.
Yeah, the comeback for value lasted like 12 months.
Right.
It was great while it lasted. Fundamentals and prices mattered for a short period of time. And what we saw certainly was value gave up all of its outperformance, is now back to underperforming growth year to date, and is something that kind of has continued to struggle into the early parts of the fourth quarter. Whereas we take this on October 28th, growth is outperforming value by 100 or so basis points. It was an interesting quarter for U.S. equities because July and September were very bad months, but in August, markets were up almost 5-6%. What we've seen in the early parts of October is that the sell-off that happened in September, it has been completely erased. We're back to all-time highs on the S&P 500. But I think when you look at your portfolio statements, markets were down. Most U.S. markets were down 4, 5, 6%, and that was reflected in kind of having the quarters that we did. I think mid cap was flat. Small and mid caps were basically flat for the quarter, and I think U.S. large cap was maybe up 0.5%.
Right.
Certainly off their intra-quarter highs. And I think looking forward, we talked about that domestic GDP number in the third quarter, and it'll be interesting to see, like as you alluded to, with the Fed tapering in November, maybe GDP coming in kind of light. What does that mean for U.S. equities? I think going into first half 2022, it's certainly going to be interesting to see how they deal with tougher comps, right? Earnings are going to be a lot better year over year. And then we're dealing with a more trend-like growth. And we're going to see how we can get through with, supply chain issues. But that's the reason that we really like being diversified. We believe in international equities, both developed and emerging. We think they offer better valuation entry points. And in the case of emerging market equities, better overall growth prospects. But I think that this idea of a diversified portfolio that has exposure to, the broad opportunity set in equities, has a component of real assets to help deal with some of the inflationary pressures and just have a differentiated return stream in the portfolio. And then that piece of core fixed income, which is so important, because if everything kind of, if risk flies off the table, we know our high quality bonds are going to be there to hold up and give us something to point to not only comfort our clients and tell them, hey, this is a part of the portfolio that's holding serve, so to speak, but also to reduce that during times of volatility and add, kind of buy these equities lower on a sell-off. Now, we haven't had a real sell-off. 4 to 5%, that's kind of normal. It was actually kind of good to see just in general because markets had just not retreated. We still haven't had a 10% correction, I think, in over 18 months. And I think that
which is abnormal, right?
Abnormal.
A correction
is completely abnormal.
It's not something that, is an every decade event. This is normal. Being off 5 in a month, I think we've gotten way too comfortable with just stock market goes up and to the right, to steal one of your phrases. And that's a lot of the dialogue I've had with clients is, hey, what happened in September? Is there anything we should be concerned about? And you're like, no, the S&P 500 is up 16, and now through end of October, we're almost up 22. Guys, it was a 5% pullback. It wasn't anything materially more than that. It's just volatility.
It's just volatility. And I think that's, we can kind of end on this note, which is the reason that it's so important to have dialogue with your advisors, and why we we really believe in it being, a two-way street. And in terms of, if you have questions, reach out to your advisor.
Right.
They'll be able to walk you through, what's going on, because I think that people have gotten used to, very comfortable with the fact that investing is an up and to the right exercise, especially when you see what is happening on the fringes of capital markets, like in crypto, and where you see these kind of, extremely large moves, and sometimes in the matter of days, and you're seeing kind of SPAC issuance kind of come up and just really kind of fly off the table in terms of appreciation. I think that it's a very constructive and healthy dialogue is going to lead you to kind of stay on the course, not get too high, not to get too low, and kind of get that steady state plateau that's going to allow you to hold on to your portfolio in the good times where you want to take maybe a little bit more risk, and hold on to your portfolio in the bad times when you want to take a little bit less risk. And I think that's where this advisor-client relationship that's healthy, that's ongoing, that's constructive is going to, be able to help get our clients to where they need to go.
Yeah, I mean, I think we end on that. I thought you said it very nicely. Look, we're looking for a relationship and an ongoing dialogue because that is proven for us to be most effective in managing client assets for the long term. So, Jason, thank you for the thoughts and comments this morning, and have a good day.
All right, take care, Dave. Have a good one. Thanks for having me on.